Hello friends, today we are going to start with Foreign Exchange Management Act forming part of your economic laws. Now before getting into the act, let us try to understand what is the need for this act. Why was an act required to manage your foreign currency? Now first let us understand the economic growth of a country is always measured by the foreign exchange reserves which a country possesses. Now how does a country get these foreign reserves? How do I accumulate these foreign reserves? These foreign reserves can only be accumulated or can only be received when we open our country for international trade. In the beginning, that is if we talk before pre-independence, India was a complete importer of materials. So when we import materials, when we import goods, we always pay foreign currency rather than receive foreign currency. So we were always deficit in our balance of payments. That is, we always used to pay to the foreign countries rather than receive from them. So now we needed some act to monitor this foreign currency. We needed a mechanism in place which will ensure the foreign currency, which is a precious resource, is managed carefully. So India in the past 50 years has taken many steps to conserve or rather to regulate and rather facilitate this foreign currency, and many steps have been taken and to preserve this foreign currency. So let us now try to understand the history of Fema, that is, when was the thought of regulation of foreign exchange, regulation of foreign currency was thought of by our government. We are lucky to experience that in the year 1939, that is much before independence, the thought of regulation of foreign exchange was thought of by the Britishers. So in the Defence of India Act 1939, there was a provision included which spoke about regulation of foreign exchange. However, that was not a standalone act for regulation of foreign exchange. In the year 1947, finally we had an act to manage the foreign currency which was named as Foreign Exchange Regulation Act 1947. This was the first act, a standalone act to manage the foreign currency. However, it is interesting to note that this act, which was enacted in 1947, was only a temporary act. That means, when I mean temporary, this act was not made permanent. However, it is to be noted that only in the year 1957, so this act was enacted in 1947 and only in the year 1957 this was made permanent. So the act was made permanent only in the year 1957. Then going forward, the government realized that there needs to be made some amendments to the act, and hence a much extensive act was enacted in the year 1973, which was the same Fera Act. However, when this act was enacted in 1973, there were many repercussions in the Indian economy. This act, which was enacted in the year 1973, had many very draconian provisions for the purpose of foreign exchange. Now, many companies, many foreign companies which were having operations in India during this period had to leave India and shut down their business because the provisions were so stringent. The provisions were so strict in this act that it was very difficult to continue doing business in India. Hence, there was a need to have an act which was facilitating these foreign companies or that will facilitate the use of foreign currency. And hence, we had this act which was Fema 1999, that is the Foreign Exchange Management Act, which was brought into force in 1999. Now, what were the problems in the Fera Act which was there in 1973? See, if you are aware, the most dreaded agency of the Indian government is the Enforcement Directorate. This agency, Enforcement Directorate, was brought into force only by this Act 1973. And the beauty of this act was, every act was envisaged as a criminal offence, mens rea. Now, when I say mens rea, what is the meaning of mens rea? It assumed that you have a negative intention, that is, the intention to go against the law was assumed by the act. So this was a big draconian provision of the act which allowed the enforcement directorate, which allowed the government to arrest anybody if there is any contravention of the act. However, these provisions were relaxed in the act Fema, that is Foreign Exchange Management Act. Now let us try to understand what was the role of Fera. Now what was the environment during the time of Fera and what went into the objectives of Fera. Now what did Fera do? The Fera was mainly enacted to control my foreign exchange. The focus of the Act Fera was not to get foreign currency into India, not to identify avenues to increase the flow in the country. The intention of this act was to whatever currency I have to preserve this currency into India. So that was the intention of this act, which is completely contrary to the intention of the Act Fema, which was enacted in the year 1999. So now it ensured proper utilization of the foreign exchange and promote the economic development of the country. Then during the time of Fera, forex was a scarce commodity. During the time of Fera, so when we are talking is much before 1991. So you all are aware, in the year 1991, the Honorable our Finance Minister Mr. Manmohan Singh had brought in lot of economic reforms. So much before that, that is before 1991, India had a very scarce commodity of foreign currency. The foreign currency was not very freely available in India because we did not enable globalization in India. We did not enable free trade in India much before 1991. Hence, forex was a scarce commodity. So something which is scarce, I have to regulate it. I have to ensure that I use it carefully. I have to ensure that I use it usefully. I don't waste this foreign currency. Hence, this Act of Fera was introduced in 1973. So because it is a scarce commodity, I do not have enough of this commodity. So for what did Fera do? It primarily prohibited all transactions, means don't do anything with foreign exchange. It is my commodity, it is precious thing which I don't have enough. If you still want to do something out of it, please go to RBI. So this was a scarce commodity. I am not going to leave it like this. So these were the various reasons, or these were the various parameters based on this Fera was evolved. Now let us try to understand what are the various fundamental difference between the Act Fera and the Act Fema. So we now understand the Act Fera was draconian. When I say draconian, it was very stringent. It had very strict measures in utilization of the foreign exchange, and hence we had an act called as Fema, which was meant to facilitate the usage of foreign currency rather than conserve the usage of foreign exchange. So as you can see, to have stringent controls on foreign exchange, Fera envisaged very stringent controls on the foreign exchange of the economy. So I cannot use the foreign exchange of the economy. It is a very precious resource. I cannot use it. However, Fema has gone completely in reverse mode, and it says I will not conserve, rather than I will just facilitate the usage of the foreign exchange. So facilitating external trade and payments and promoting orderly development. So I am only going to promote the external trade of the economy. I am not going to sit and concentrate on how to conserve this scarce commodity. I am now going to look into avenues how to make this scarce commodity into a abundant, something which is abundant, which is available in India. So my intention is not to conserve this. My intention is to increase the presence of foreign currency into India and then regulate and manage this commodity into India. So basically, the basic framework of Fera and Fema had been changed by this act. Now, so why Fema despite Fera, that we have already discussed. Fema was draconian, and hence we had Fera was draconian, and hence we got Fema. So Fera severely regulated all the foreign transactions. So as we discussed, India was suffering from very low foreign exchange reserves. So however, if you see now, that was in the year after the year 1991, when the economic reforms were introduced by our Finance Minister Mr. Manmohan Singh. lot of globalization happened, lot of cross-border trades were happening, many foreign companies set up shop in India, and when that started happening, the foreign exchange reserves started increasing. So hence there was a need to have another act which shifted the focus from conservation to management, and hence we had a Fema. So management was to be sought than control. So that is what I told you now. So management was sought. So the new act had to focus on management rather than control of this foreign currency. So we needed a law which is liberal in the sense which manages the foreign currency and which doesn't see anything mens rea, that is, which gives an equal opportunity for the other party to explain its stand. Now, Fera becomes incompatible with the pro-liberalization policies of the government of India. So now, since in 1991 we had economic reforms coming into India and so much of globalization happening all over India, this Fera was not fitting into the scheme of things, and hence we obviously wanted a new law which can manage the foreign currency. And see, for this, all this happenings during this decade of 1990 to 2000, even the RBI took a lot of actions. There was a Tarapur committee which was set up by the RBI to study the whether this Fera Act is effective in India or we need to overhaul this entire act of managing the foreign currency. And the Tarapur committee rightly suggested that the Fera Act has to be completely rehauled and a new act needs to be introduced, and hence the RBI started working on the new act, that is the Foreign Exchange Management Act, and it was finally enacted in 1999. Now, so Fera versus Fema. Now let us try to understand the critical differences between Fera, that is, let us try to understand the striking differences, technical differences, what was there in Fera and what was there in Fema. Now when I say about object of the act, this we have already discussed, the objectives of the act. The objective was to control. However, in Fema, the objective is not to control the foreign exchange, the objective is only to regulate and manage, or I can say it is there to facilitate the foreign exchange, means I will help you in managing the foreign exchange. I am there to help you. I am not here to control, I am not here to conserve, I am only here to help you in managing the foreign exchange. So that was the main objective difference of the new act. Residential status. In the case of Fera, the citizenship was the predominant reason based on which the residential status was determined. However, in the case of Fema, that was also completely rehauled and a new mechanism of identifying the residential status was enacted. So we will study this in detail in the next coming forward units. Now, ease of transactions. All the transactions were prohibited unless permitted. That means I am prohibiting everything. Don't do anything unless I allow it. Means I will not allow anything. If I want to allow something, when I say I mean the RBI, I mean the government of India. The government of India will allow you to do something. You can only do those transactions under the regime of Fera. But in the case of Fema, transactions are permitted unless prohibited. That means transactions are generally permitted. However, some transactions which I feel should be prohibited, the government will prohibit. Again, I means the government. So the government has generally allowed all the transactions. However, some transactions which are critical because of the situations in the country, they will prohibit. So that was the intention of Fema. Now, presumption of mens rea, this we have already discussed. Fera assumed accused had to prove his innocence. Accused had to prove his innocence. Presumption of mens rea existed, means the accused had to prove himself that he was innocent. However, in case of Fema, the prosecution will have to prove that the person has committed an offense. So, in the case of Fema, it didn't have mens rea as a concept. That means the law, that is the government, will not assume that you have made an offense. It is the law which has to first prove that you are an accused in the case of Fema. So, Fera had mens rea as a concept. It assumed existence of mens rea. However, Fema did not assume existence of mens rea in case of Fema. This was the most striking changes in the act between Fera and Fema, that is existence of mens rea. Now, what were the other differences? Now, compounding of offences. Now, what is the, so let us see what is compounding of offences. In Fera it was not allowed, however in case of Fema we had allowed compounding of offences. Now, when I say compounding of offences, let us try to understand what is the meaning of compounding of offences. Now, in case of Fera we did not allow compounding of offences, means in case an individual commits an offence, immediately he is arrested in case of Fera. However, in Fema, we do not arrest a person. Instead, there is an option given to him to compound his offence. That means he can pay a penalty in lieu of his imprisonment. Hence, we allow the compounding of offence, means we ask him, we give him an option that you can pay a penalty instead of getting arrested. So, the compounding of offences got allowed in Fema. So, this was again a big tick mark in the case of Fema, means I have done some mistake, I have done some offence, I have done some non-compliance. Don't penalize me by arresting me, instead allow me to correct it. How? Allow me to pay a penalty for it and let me understand my mistake and let me not repeat the mistake instead of arresting me as it was envisaged in Fera. So, that was a big tick mark in case of Fema. Appellate authorities, there were only one appellate authority in case of Fera, but in case of Fema we allowed them, that is the government allowed 2 appellate authorities. Hence, a better mechanism of appeal system was enabled in Fema. We will discuss all these provisions in detail in the forthcoming units. So, what was the role of RBI? The role of RBI was a regulator, it was a watchdog, it was always trying to see what was happening with the foreign exchange. But however, in case of Fema, it is only a facilitator, it just oversees what is happening, it just oversees what is happening in the economy with regards to the foreign exchange. It is no more a regulator as envisaged in Fera. Now, the next one was power to arrest. If authorities had reasons to believe that person is guilty of Fera violations. So, the moment I believed that I had reasons to believe that you have done an offence, I can arrest. The authorities could arrest an individual during the regime of Fera. However, power to arrest on non-payment of penalty and non-furnishing of security. However, in case of Fema, I give you an option of compounding of offence. So, when I am giving you an option of compounding of offence, then if you opt for that option, then the arrest does not happen. However, if in case you do not pay the penalty, if you do not meet the conditions of the compounding, only in that such a scenario, a power to arrest is enabled in the case of Fema. Now, so we have now understood what are the differences between Fera and Fema, what were the lacunae in the act Fera, why Fera was envisaged, what changes happened in the economy after Fera getting enacted in 1973, what changes happened in the economy and why there was a need to enact a fresh act, we have understood. Now, let us see, this Fema has been brought into force from 1st June 2000. So, the act Fema was brought into force from 1st June 2000. All this please register in your mind. So, the act extends to whole of India. So, as you would have read in some of the other acts, generally some of the acts do not apply to some states like Jammu and Kashmir. However, the act of Fema applies to whole of India. There is no exceptions on account of that. So, the act applies to each and every state, each and every union territory of India, it applies everywhere. Also, so there is no question of exceptions, it applies to some other places also. Let us try to understand what is the act, what is that. Also, the act has extraterritorial jurisdictions. This act has extraterritorial jurisdiction. Now, what is that? It applies to all branches, offices and agencies outside India. It applies to all branches, offices and agencies outside India. That means, a branch is existing in London, say for example, will it apply? So, let us read the full definition. It says all branches, offices, agencies outside India owned or controlled by a person resident in India. That means any branch, office or agency which is outside India. Say for example, take the case of Reliance. Now Reliance has a branch office in USA. It has a branch office in California. So now this branch office belongs to whom? This branch office belongs to Reliance, owned by Mukesh Ambani, which is a resident of India, and hence the law of Fema will also apply to this branch which is situated in California. So in a nutshell, what we understand, this act applies to whole of India. This act applies to whole of India plus it also applies to any branch, office, agencies outside India controlled by a person resident in India. That means always think from your angle. Suppose you are having a company in India and you have a branch outside India, that is you have a branch in Singapore, you have an office in Singapore. That office is owned by whom? It is owned by you. Since it is owned by you, you are a person resident in India. So hence the branch which you own in Singapore will also be applicable to Fema, which will also come under the surveillance of this act, that is Fema. So it also applies to any contravention committed outside India. So it also applies to any contravention committed outside India by any person to whom this act applies. So this act applies to all branches, offices and agencies outside India controlled by a person resident in India. However, plus it also is applicable to any contravention which happens outside India to whom this act applies. Say for example, I am Mr. Mukesh Ambani. So, or example, say Mr. Mukesh Ambani goes and travels to Singapore. Now, when he goes to Singapore and any contravention happens, even the act applies to that situation. That is, even though Mr. Mukesh Ambani is not in India, he is in Singapore. However, any contravention of the act happens, it applies in that situation also. So, this is in nutshell the applicability of this act, that is Fema 1999. So, now before getting into the details of the act, let us try to have a short understanding of what is the preamble of this act. What was there in the preamble of the act? So, what is this act? An act to consolidate, an act to consolidate and amend. So, an act to consolidate and act to amend. So, consolidate because we already had the previous laws on foreign exchange. So, this act was meant to consolidate, was meant to amend. So, the previous act would have whatever it is, some lacunae. So, we need to amend those acts relating to foreign exchange, with what objective? With the objective of facilitating, external trade and payments. What is the meaning of external trades and payments? External means foreign currency payments. So, external trade, that is your imports and exports and the related payments, and for promoting the orderly development and maintenance of foreign exchange market in India. So, if you see from this preamble, the intention of the act is very clear. I just want to facilitate, I just want to help the economy to manage the foreign exchange in India. Now, with this understanding, we will now move on to the definitions part. See, every act will give a list of definitions. So, similarly, in your Fema Act, we have been given a host of definitions. As part of this, we will try to understand some definitions in the beginning, and other definitions will take it up as and when we go through the learning units. The first definition we will go through is the authorized person. Now, who is an authorized person? The most frequent word which you will be listening to this in this Fema chapter is authorized person and currency. Now, who is an authorized person? Now, say for example, you want to travel to London. And you need some currency to spend in London. Exactly. So, now this currency, how will you get it? Will you go and stand in the front on the doors of Reserve Bank of India and tell to the governor, please give me 1000 GBP, please give me 1000 US dollars? Is it practically possible? This is practically not possible. Just imagine the population of India, and if everybody goes and stands in front of Reserve Bank of India, how will this work out? It will not work out. So, to manage this foreign currency, to manage this Fema, to manage the demand of this foreign currency, we have something called as authorized person. This has been envisaged. Who are these authorized person? Basically, I will say rather 75% of the activity under Fema is being done by authorized person only. These are the entities who perform the majority of functions under Fema. So, under this Fema, the government, the Reserve Bank of India, has entrusted the responsibility to whom? To these authorized person. Who are these authorized person? Can we become an authorized person? See, say for example, I want to start a grocery shop. So what do? I open a grocery shop. I get the GST registration if it is required. I open a grocery shop. Similarly, can I become an authorized person at my wish? No. It is a serious business. It is a serious business because I am going to handle foreign exchange. And in that scenario, these authorized person will have to get the necessary approvals from whom? From the Reserve Bank of India, and then only they will be authorized to become an authorized person. Now, with this background, simply said, who is an authorized person? Generally, it is the bankers. What you can keep in your mind? Authorized person means generally bankers. Bankers perform the role of authorized person. Say for example, if you take for example Axis Bank. Axis Bank, all the branches of Axis Bank, or not, if not all the branches, some of the main branches which are located in the business hubs of any city, they will be designated as forex branches. Means the role of that branch is to handle foreign exchanges. Because there will be many business customers there. Those customers will have the requirement of foreign currency, and hence the banks, what they will do? They'll approach Reserve Bank of India, boss, we also want to become an authorized person. So generally, every bank will be an authorized person. They will take a separate license from the Reserve Bank of India to act as an authorized person. Now, in addition to banker, can anybody become an authorized person? Yes. So these money changers, Western Union money transfer, all these are authorized persons. So they will have to approach the Reserve Bank of India and take the license to operate as an authorized person. Now, with this, we'll learn the definition as given in the Act. It says, authorized person means an authorized dealer. Authorized dealer, money changer, offshore banking unit, or any other person for the time being authorized under subsection 1 of section 10 to deal with foreign exchange or foreign securities. Means it includes an authorized dealer, money changer, or anybody who is authorized under section 10 to deal in foreign exchange. So in simple terms, authorized dealer means a person registered under section 10 of Fema Act. So generally it is whom? It is the bankers who are the authorized person. Now the next important definition is currency. So what is this currency? Currency means all currency notes including postal orders, money orders, checks, drafts, traveler's check, letters of credit. Now what is all this? You know currency notes, you know postal orders, you know checks, you know drafts. What is traveler's check? See, traveler's checks to an extent is an outdated concept. Nowadays, we generally do not use traveler's checks. See, previously what used to happen, if I am traveling to London, so what happens, I go to the bank and I get a traveler's check of 1 lakh. I get a traveler check of 5,000 USD, whatever it is. So this traveler check I will use when I travel to the specific country. Now we have concept of forex cards. What is forex cards? You're traveling to London. So before traveling to London, you approach Axis Bank. You tell to Axis Bank, boss, I am traveling to London. Please load 5,000 USD in my forex card. He will load $5,000 in your forex card, and whenever you travel to London, you can just swipe this forex card. So we have the concept of forex cards now, and rather most of our debit cards, most of our credit cards are now, we can utilize this or we can use these cards when we are traveling abroad. So travelers check. Letter of credit. What is a letter of credit? Letter of credit is again a financial instrument under which what happens, you guarantee another person that this person will be paying the amount on the due date. Again, this is LC. Then bills of exchange and promissory notes. Again, your interconcepts. Credit cards or such other instruments. See, basically we are trying to cover anything which creates a financial liability. So all your currency notes, your checks, your drafts, your credit cards, your debit cards, what are these? These are instruments which results in creation of a financial liability, and that is what the section is trying to say. So as may be notified by the Reserve Bank of India. So here RBI has notified debit cards. Debit cards, is it a currency? Yes, it is a currency. ATM cards or any other instrument by whatever name called, that can be used to create a financial liability. The important part here is any instrument. See, I cannot define every instrument. So what I am saying here, any instrument which creates a financial liability is called as currency. Is the concept clear? What is a currency? So currency means doesn't mean that only this currency only this note is a currency. No, even your debit cards, your credit cards, any instrument which results in creation of a financial liability is a currency. So you have now understood the meaning of an authorized person and then the meaning of a currency. We'll now move on to the next definition. So we have understood what is foreign currency, what is currency. Now this is we only read about currency. Now what is an Indian currency? Indian currency is nothing but your Indian rupees. Now what is a foreign currency? So the concept is simple. Any currency which is not an Indian currency is a foreign currency. So for example, if in our situation we are in India, so the INR is the Indian currency. So anything other than INR is a foreign currency. So say for example, you can take USD, you can take British pounds, you can take Singapore dollars, Australian dollars. All this will form part of your foreign currency, and there are around more than I suppose more than 150 foreign currencies in the world. So these are foreign currencies. Now, so we have now understood what is currency, what is Indian currency, and what is foreign currency. Now let us try to understand what is foreign security. So what is foreign security? It means any security. So security means, generally we always understand it is nothing but shares or any instrument. So like in the form of shares, stocks, bonds or debentures. So shares, stocks, bonds or debentures or any other instruments expressed in foreign currency. So the important point here to be noted in case of foreign security is, you have stocks, you can have stocks, you can have debentures. However, this stocks or debentures has to be denominated in foreign currency. So when I say it has to be expressed in foreign currency. So say for example shares of Reliance. Now in case of shares of Reliance, is shares of Reliance a foreign currency? No, because the shares of Reliance are denominated in INR. So it cannot be a foreign currency. So any security which is denominated in Indian currency is not a foreign security. So the first condition for a security to qualify as a foreign security is that it should be denominated in a foreign currency. The moment you see it is not denominated in foreign currency, the doubt is removed. There is no question of it being a foreign security irrespective of other definitions. So now we will go to the second part of the definition. So what is the first part of the definition is what? Foreign security means any security in the forms of shares, stocks, bonds or debentures, provided it is expressed in foreign currency. So that is my first part of the definition, the first leg of the definition. If this is satisfied, only I need to go to the next leg of the definition. And what is the next leg of the definition? It includes, so The first point is it has to be in foreign currency. Please register in your mind, it has to be a foreign currency. It cannot be denominated in Indian currency. The moment a security is denominated in Indian currency, it is out of scope of foreign security. Say for example, I denominate a security in Indian rupees, however it is issued to a foreigner, even then it is an Indian security, because irrespective of who is holding the security. Suppose I have a security, say for example shares of Reliance are owned by a person in London. Does it become a foreign security? No, because it is an Indian share which is denominated in INR. Now, however, if Reliance goes and lists some shares in NASDAQ, then what happens? Then it becomes a foreign security because it is denominated in the foreign currency. So now if you see, now many of our Indian companies are listed in NASDAQ, like Reliance, say for example your Vedanta, Infosys, most of the IT companies are getting listed in the NASDAQ exchange. So the securities listed in the foreign country is a foreign security, denominated in foreign currency is a foreign security. So that is the first leg of the definition. The most important condition is it should be denominated in foreign currency, and it includes securities expressed in foreign currency but whether redemption or any form of return such as interest or dividend is payable in Indian currency. So let us try to understand this in simple terms. So now when I told you the first leg of definition, that is, what is the first leg of the definition? The first leg of the definition starts from here and ends here. So this we understood clearly, it is stock, debentures or anything, any form of security denominated in foreign currency. Plus it also includes securities denominated in foreign currency. It also includes securities denominated in foreign currency. However, the redemption or the return is in INR. Now, if you see in this situation, the first leg of the definition, we said the security is denominated in foreign currency. So, we are assuming that the redemption and the return also may be in the foreign currency. Also, this I am anyways including, but I am also including securities which are denominated in foreign currency, but the redemption, that is at the end of the maturity of the security, the money proceeds will come in INR, plus the returns, that is the dividend or the interest income will also come in INR. So now we are able to understand the definition clearly. So let us now just have a relook at the definition. Foreign security means security in the form of shares or debentures or any other instruments denominated in foreign currency. Is clear. Second thing is, I will also include securities expressed in foreign currency, because I am still not going to Indian currency. So securities will still be denominated in foreign currency, but the redemption, that is the closure, will happen in INR, or the interest or the dividend income may come in INR. Those securities are also foreign securities. Now, let us see the next point. The next point is the foreign exchange. Now, foreign exchange means foreign exchange means foreign currency. So that means what is foreign currency? Foreign currency is any currency other than Indian currency. So what is Indian currency means? INR. So anything other than INR is foreign currency. That means if you see to the currency, this currency, when I spoke about this currency, so currency includes what? Currency includes notes, currency includes checks, currency includes drafts, currency includes traveler's checks and everything. So instead of in this currency, just add as foreign currency. So it includes foreign currency. So it means foreign currency and includes deposits, credits and balances payable in any foreign currency. Now what is the difference between foreign currency and foreign exchange? So when I have said foreign currency, it is nothing but foreign currency is anything which is other than Indian currency. But when I say foreign exchange foreign exchange includes foreign currency and it includes deposits, credits and balances payable in any foreign currency. That means, say for example Reliance Industries. Now Reliance Industries has any deposits or it has any balances or it has any loans payable in foreign currency, even that will form part of foreign exchange. Means anything which is payable in foreign currency is a foreign exchange. So deposits, credits and balances payable in foreign currency. Now next, drafts, travelers checks, letter of credits, bills of exchange drawn in Indian currency but payable in foreign currency. So any travelers checks, any checks. Now when I say this, let us try to understand in a simple term. Now say with the help of an example. Now the second point says drafts, travelers checks, letters of credits. So all these instruments drawn in Indian currency but payable in foreign currency. Again in simple terms, what does it mean? Say for example, I want to travel to US. So when I travel to US, what happens? I need foreign currency. I need US dollars. So when I need US dollars, I go to my bank, that is State Bank of India, and I tell them that I want 5 lakh INR worth of US dollars. So the bank gives me foreign currency. How it gives? It loads this foreign currency into my forex card. So I give to bank what? I give to bank Indian currency. So it is drawn in Indian currency, but this forex card is usable when it's usable when I travel to US or in whichever countries this card is valid. Say for example, when I travel to US, I swipe this card. So whenever I swipe this card, it is payable in foreign currency. So even that is a foreign currency, foreign exchange. So foreign exchange includes all this forex card because these are payable in Indian currency. These are denominated in Indian currency, but ultimately gets paid in the foreign country as foreign exchange. Now, what is the next part? Drafts, travelers checks. Again, the same list of items. Drafts, travelers checks, letter of credits, bills of exchanges drawn by banks, institutions, or persons residents outside India but payable in Indian currency. Now, what is the difference here? Means, say for example, any exchange, say for example, a person in Singapore, he gets a, say for example, Mr. Mukesh Ambani, he earns some, he is part of Harvard University. Say for example, as a honorarium, he receives from Harvard University any drafts for as a remuneration or as a honorarium. So now that honorarium is denominated in which currency? That is denominated in the foreign currency. However, when he deposits this currency, this foreign instrument in India, it is payable to him in Indian currency. It forms part of foreign exchange. So this is the third leg of the definition. So let us try to understand the three part of the definition. Foreign exchange includes, means foreign currency. It includes any amount payable in foreign exchange plus any demand draft, any drafts, any travelers checks or any instrument which is payable, which is denominated in Indian currency but payable in foreign currency, and similarly any travelers checks or any draft which is denominated in foreign currency but payable in Indian currency. Now, with this we will end the unit 1 and we will continue with the unit 2. Thank you.